When we look at world history, the power of the British Empire is often told through military victories, impressive fleets, and vast colonies. But this is only the visible surface. True power was much quieter, originating from a deeper and less obvious source. It operated behind the thrones, in the intricate financial system, within grand marble halls, and behind polished mahogany desks. This system was essentially a sophisticated machine that transformed debt into power and money into an empire. Bankers in London did more than just fund wars. They could manipulate crises, trade, and even famines to serve their own interests. The story behind Britain's global dominance actually provides insight into the origins of the modern world's financial systems, showing how credit, debt, and investment were transformed into instruments of power. To understand this, we must travel back to the 17th century. At that time, England was far from the global superpower it would later become. Spain and Portugal dominated with their enormous colonial empires, extracting wealth from the Americas and Asia. France was emerging as a central player in European politics, with a powerful army and an ambitious monarchy. Meanwhile, the Dutch Republic had created a sophisticated financial infrastructure, combining naval power with advanced trade networks, making it a formidable economic competitor. England, by contrast, was a small, fragmented island nation, constantly struggling with cash shortages and political instability. The state treasury was continuously drained by wars, and the king's repeated attempts to borrow money frequently ended in default. These failures undermined investor confidence and created cycles of financial panic. By the late 1600s, England's creditworthiness had practically collapsed. Without reliable access to credit, it was impossible to finance armies, expand the navy, or exert influence on the global stage. The year 1694 became a turning point for England. Parliament approved the establishment of the Bank of England. Its initial concept appeared simple. Wealthy investors would lend money to the government for a war against France, receiving fixed-interest government bonds in return. Yet this was only the beginning. The bank institutionalized government debt, transforming it into securities that could be bought, sold, and traded on the open market. The unreliable promises of kings were now converted into instruments that investors could trust. With this system in place, the British state could borrow large sums at low interest rates, backed by the confidence of the financial market. This was Britain's invisible weapon, the backbone of its future power. Wars were no longer won solely with cannons and rifles. The London bond market had become a battlefield in its own right. Take, for example, the War of the Spanish Succession in the early 18th century. England, a relatively small island nation, managed to maintain armies and fleets across multiple European theaters for more than a decade. How was this possible? Not because it had greater natural resources than France or Spain, but because it had cultivated a credit system that commanded investor trust. Revenue from taxes and trade ensured debt repayment, creating a virtuous cycle of borrowing and confidence. France, on the other hand, repeatedly defaulted on its debts and struggled under mounting interest obligations. Wars were now won not only through military strategy and heroism, but also through financial acumen. The system expanded dramatically during the 7 Years' War. In the 1750s, Britain borrowed over £100 million, an enormous sum for the time, to finance global campaigns stretching from North America to India. While France was theoretically larger and richer, it lagged behind financially. Its debt burden crippled the state and created conditions ripe for revolution. Britain, by contrast, expanded its base of bondholders and investors, consolidating both financial and military victories. War had become more than a test of bravery. It had become an investment opportunity. Trade was another pillar of this financial empire. Companies like the East India Company operated as hybrid entities, bridging the gap between the state and private investors while generating enormous profits. Revenues from commodities such as spices, textiles, and opium were underpinned by military protection, local bribes, and tax collection. These profits flowed back to London, enriching bondholders and bankers alike. This created a feedback loop connecting debt, trade, and conquest. The invisible architects of Britain's empire were the bankers who kept credit fluid and the financial markets alive. This system reached its zenith during the Napoleonic Wars. France remained a formidable military power but was financially fragile, relying heavily on plunder and contributions from conquered territories. Britain, however, had continuous access to funds through the London bond market, borrowing over £600 million during the conflict. Investors trusted the system, and Britain honored that trust, ensuring uninterrupted access to capital. The outcome: Napoleon was defeated not just on the battlefield but in the financial arena as well. Yet the domestic consequences of this system were stark. Ordinary taxpayers bore the cost of war through duties on tea, sugar, and tobacco, while London bankers consolidated wealth and power. The combination of money and authority kept the empire standing while marginalizing the most vulnerable sectors of society. In the 19th century, wars continued, but most victories were achieved in accounting rooms and trading halls rather than on battlefields. The Opium Wars in China vividly illustrate this dynamic. Financial leverage in trade became more decisive than military might. By the mid-19th century, Britain had become not only the workshop of the world, but also the world's banker. The pound sterling emerged as the dominant currency in international trade, and London became the global center for debt and capital flows. The gold standard reinforced this power, creating a stable and reliable financial environment. International investors could safely transfer their capital to London, while borrowing nations had to operate under London's financial rules. However, this system had a human cost. Profit and security for investors often meant famine and poverty for colonized nations. In India, grain exports led to recurring famines, while London bondholders collected their guaranteed interest. The ruthless logic of the financial system was revealed in its starkest form here. Britain's global dominance was therefore not the result of military might alone, but of a skillful integration of debt, credit, and trade. Even crises were transformed into investment opportunities. American infrastructure, for instance, was constructed with capital from London financiers. The modern financial mechanisms we use today, credit, bonds, national debt, are a direct legacy of this system. Today's debt-financed wars, financial bubbles, crises, and bailout packages are built upon the same foundations. A system that turns money into a weapon and debt into a tool of power is still operational. The lesson is clear. Financial literacy is no longer optional, it is essential. History can crush those who fail to understand the power of money and credit, forcing them to play by the rules set by empires. History may not repeat itself, but ignoring it can yield eerily similar consequences.